Hello everybody, Tortoise Investing coming at you today with 3 of the best dividend stocks to buy now. If you are new, join me on this investing journey. We are basically starting off fresh here. These are the current holdings that we have, and you can watch me build this into something phenomenal over the next couple of years. I would love if you would join me on this journey. Just dropping a sub and hitting the like button on the video. And let me know if you own any of the stocks that we're going to be taking a look at today. Mastercard, Accenture, or Vici down below. Would love to hear from you. None of this financial advice, always do your own research for investing. Now, without further ado, that's just a quick little look at the portfolio. Let's take a deeper dive into our stocks. So, first one we're taking a look at is Mastercard. This is an absolute juggernaut of a company. I love Mastercard, and I intend to buy on any dips. Just a free cash flow yield of 2.53%. We've got a dividend yield of 0.59% and a payout ratio of 19.54%. So, low on the yield, low on the payout ratio, but we've got a quick growing dividend with this one. Let's take a look here over the last 5 years, up 69%, over the last 10 years, up 481%. So a very strong compounder indeed. Take a look at the revenue over the last 5 years, growing at a rate of 10.92%, over the last 10 years, 11.64%. So right in line, great double-digit growth from this one. So we're going to take a look here at revenue by segment. And as you can see, this has been growing. The thing with the quarterly too is very reliable growth out of the revenue quarter over quarter and the total number of Mastercards issued. This is just something that is just phenomenal. And as you see here, it has only not grown once. It's from 2021 to 2022 here, Q4 to Q1. But besides that, we are just growing like crazy with total number of Mastercards out there. And the more Mastercards there are, more people are going to use them, the more fees that Mastercard can ultimately collect, and that revenue and that free cash flow will continue growing. And the free cash flow growing at a rate of 11.71% over the last 10 years. If we take a look here for adjusted 11.44. There we go. Free cash flow per share, 14.53. That's one that we wanted. And this is showing us that they are buying back shares. So we are getting more and more bang for our buck. And that's what a lot of companies will do. If they have extra cash, they can either pay it out in dividends, make acquisitions, or buy back shares. And Mastercard, they love buying back shares. Let's take a look here. Over the last 10 years, a rate of 2.47%. It is just trickling down, which is something that you want to see. Absolutely love when companies do this. Of course, you want them to buy back cheaper shares. You don't want them, if it's evaluations are through the roof, buying back shares then, because it would be best to sit on that cash until there is a dip. But they do a great job at buying shares back at a good price. Their debt, cash to debt here, take a look at the quarterly. 13.5 in debt, 7.66 billion in cash on hand. That is not an issue. Their EBITDA last year was 15.35 billion. My general rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt. That shows if something major was to happen, if there were financial troubles, it'd be a little bit harder for them to stay afloat and keep things rolling. But that is not the issue with Mastercard. Beautiful balance sheet, beautiful free cash flow, beautiful revenue growth, total number of Mastercards is growing, buying back shares, return on capital employed is silly, 55.56% last year. Market averages are like 9 to 10%, so this company's just absolutely killing it. And the dividend, as I mentioned earlier, growing at a rate of 19.62% over the last 10 years, over the last 5 years, right at 15%, so still just big stairs just going up and to the right, which is beautiful. That is some compounding going on there. The longer you hold it, you get price appreciation, you get that nice increase in dividend yearly, and you can just roll that into more and more shares and just build that snowball. Next up, Accenture. This is one that is new To me, it's one I've been looking into. It's on my watch list. I think it's at a pretty decent valuation currently. Adjusted free cash flow yield of 3.79%, dividend yield of 1.79%, a payout ratio of 45%. Let's take a look here. 5 years up 56.37%, 10 years up 244.81%. So very nice. Very similar here. The revenue up and to the right, not growing as quick as Mastercard. Over the last 10 years, 7.75%, but still nice. Still pretty good growth there. Free cash flow growing at a rate of 11.86% over the last 10 years. Again, very nice. We take a look here. 12.12, which again tells me they are buying back those shares. Love to see that. EPS growth, 8.13% over the last 10 years. Again, just a very reliable grower. And the debt, they don't have any debt, which I love. They have they have a little bit of debt now, 71 million for their 5 billion in cash, but as you see here, they've not carried much debt. Looks like they took something out last quarter, which still is not an issue whatsoever. Let's take a look at the dividend, growing from 80 cents to 88 cents to 97 cents to $1.12 and to $1.29 in 2024. They did have a cut, it looks like right at the end of 2019, but let's take a look at the last 3 years. Pretty quick growth, at a rate of 15% on average. That's very nice. And like I said, those shares being bought back at a rate of 1.09% over the last 10 years. Again, you want your companies to be doing that. If they don't know what else to do with their allocation, if the stock is in a dip, like it is now, buy back those shares. So I hope that they are taking advantage of this and that they are gobbling up some shares right now, especially after that dip being down almost 17% year to date. And the return on capital employed, again, very nice, very strong numbers here. 26, 27, 31.5, and then as of last year, 26.51%. So very, very good, very strong numbers, and a beautiful financial sheet as well. Next up, we have Vici. This is from my high dividend wanners out there. Dividend yield of 5.85%. We don't really look at the payout ratio. This is a REIT. REITs are different. They're treated differently. You want to look at the funds from operation, the FFO. You don't want to look at the earnings per share. Revenue, bonkers. This company has just been growing crazily. Been doing some acquisitions and stuff as well. Free cash flow is growing, which you love to see. Of course, there's going to be some debt. It's a REIT. REITs usually take out a lot of debt and leverage. The dividend, though, for a dividend, it's almost 6%. You're getting over 7% growth over the last 5 years. I just think that is phenomenal. And out of all the REITs, Vici's definitely up there for me. I would love to see this thing hit like 26.5, 27. It would be very hard to pass up at those prices. But yeah, do you own any of these? I would love to hear from yins down below. Let me know if yins have any Mastercard, Accenture, or Vici. Before we go, we can take a look here at the analysis estimates for these. So for Mastercard, EPS for this year, $14.29 growing to $16.56 next year, so it's double-digit growth. And the revenue, $27.84 billion growing to $31.3 billion. So again, I think that is also double-digit growth, so that's very nice. Analyst estimates average for Accenture, $11.17 growing to $13.11. So again, nice double-digit growth there. And the revenue, $64.657 growing to $69.57. So that is mid-single-digit growth. Still pretty solid growth overall, though. And with Vici, we'll take a look at the revenue. 3.80 growing to 3.94. So one thing that is going to help a lot of REITs out, companies that do have a lot of debt, is when the Feds finally do cut interest rates. I don't know when it's going to happen. It keeps getting pushed back further and further and further. We went from having 7 rate cuts this year, possibly to we might not even have any. I don't know. Market's a strange place. Anyways, I hope yins enjoyed that. I appreciate yins for dropping by and checking everything out. And until next time, I hope everyone takes care. See you.